I think taking all the evidence together, it's much more likely than not that the world economy is going to surprise people on the upside rather than the downside in the next 6 months. There's been a pretty sustained recovery in the world economy since the low point in the summer of 2009 after Lehman. There were 18 months of very solid growth in late 2009, 2010. That fizzled out in the beginning of 2011 with the oil shock, the Japanese tsunami, the liquidity tightening in China, and of course the crisis in Europe. Markets naturally got quite bearish in the summer of 2011, but then in September, October last year, things began to recover again, especially in the US and China. And I think that is now a pattern that's going to be sustained. There's been a hiccup this spring, but the chances are that the surprise will be on the upside rather than the downside. Probably the biggest factor in the market's mind has been Europe. That's been on the front page of every paper in the world for the last year. But in my view, for that very reason, because it's been so prominent, it's actually less likely to drive the market in the year ahead. And that's because markets aren't moved by events, they're moved by unexpected events. And by definition, something that's been on the front pages every day is not going to be unexpected unless it moves in a direction that's way beyond the kind of scenarios that have already been discussed. So I actually think that what's more likely to drive the markets in the second half of 2012 will be not what happens in Europe, but what happens in China, emerging markets, in the US. People have got quite pessimistic about the non-European world as well as about Europe this spring. If in the summer months we see signs of improving economic activity in the US, we see more stimulus plans coming out from China, then the chances are that those will be the factors that dominate the market rather than anything that's happening in Europe and Greece. Well, the Greek elections, which are in June 17th, are going to be the focus of attention before then, no question about that. In my view, the chances of Greece actually leaving the euro after those elections, they're significant, but they're certainly no more than 50%. It's probably as likely as not that, in fact, the Greeks will end up being intimidated by all the threats from the Germans and the ECB and will end up voting for the establishment parties which are committed to the current adjustment program. If that happens, incidentally, it's almost certain that Europe will make various concessions as a reward for the responsible behavior of the Greeks. I'd say that's about a 50% chance. But even if we look at the 50% chance that the radical parties will be elected, once that happens, there will be a period of negotiations, whatever the radical parties say before the elections. And there's at least a decent probability, maybe a 10-15% probability, that a deal will be done involving some concessions, which will be enough for the radical parties to turn to their voters and saying, look, we achieved something by standing up to Europe and the Germans, but is not so provocative that Europe pulls the plug. And that leaves the other probability that the Greeks actually say, we're out of here. We are not going to put up with this. Even under those circumstances, there's a serious chance that basically Europe will blink rather than Greece blinking. So Greece will threaten to withdraw and Europe will say, okay, well, in that case, we'll tear up the memorandum and we can start again from fresh. So I think that leaves only maybe a 15 to 20% probability that Greece will actually pull out of the euro after the election. That would be my judgment. 80% they stay, maybe 20% they get out. Well, if my assessment of the world economy is right, in other words, that the second half of 2012 is actually going to surprise people on the upside, not because of events in Europe, but because of events in the emerging markets and the US, if that turns out to be right, then equities and other risk assets, but particularly I would say global growth stocks, are the place to be. They're very cheap at the moment by historical standards, and they're actually discounting a long period of Japanese-style stagnation, not just in Europe, but also in the US and the world economy. If that turns out to be false, those are going to be the most attractive assets. I think the dollar will be the most attractive currency under those circumstances. The most dangerous assets in that scenario are going to be the supposedly safest, highest quality government bonds, which have enjoyed an enormous flight to safety over the last 6 months, as investors have frankly panicked about the situation in Europe and panicked about the possibility of a long-term stagnation in the US. Government bonds all over the world are at the lowest levels of yield for 50 years, in some cases the lowest levels ever. Those could correct very, very significantly if the world economy turned out to be even a little bit stronger than the very pessimistic scenarios that are built into prices today.